Hello, this is the lecture on accounting for Introduction to Business. Accounting is a very important area in the business. It's not simply about money, it's about understanding what's actually happening in the business. It's an information system, really. So even if you aren't an accountant, if that's not your profession, it's important to understand some basic concepts in accounting. Of course, there are many types of accounting jobs. We have bookkeepers. Bookkeeping is a generic term, or bookkeeper is a generic job. Basically, somebody who keeps track of payments and receipts and so forth. And there are many people who are bookkeepers who don't necessarily have formal training, but they can perform that function. Of course, we have private accountants. These are professionals who are certified to help with the bookkeeping and the other functions that need to occur. There are auditors. Auditors are outside accountants who will come in and audit the books, the accounts. This is primarily for publicly traded companies where the accounts and the financial statements must be certified to investors or potential investors, essentially to the public. And we'll talk about those types of firms coming up. Then, of course, there are tax accountants, essentially making sure that all the taxes are paid, everything that is due is done. And of course, perhaps finding ways to reduce tax liability. And that's kind of a more specialized area. Of course, the question is, what is accounting? Essentially, it is the recording, classifying, summarizing, and interpreting of financial events and transactions so managers and others can make decisions. So we need, and essentially, it's, as I said earlier, it's an information system. It tracks assets, liabilities, owner's equity, revenue, expenses, dividends, and of course, cash. It also tracks two different sources of capital. And that is, of course, equity investment, people buying stock or buying a portion of the company. And the other is, of course, debt financing, where essentially the company or the firm borrows money from outside sources. And interesting that creditors, people who you borrow money from, have first claim on the assets as opposed to the investors. So some people may not feel that's right, but actually it needs to work that way for our system to function. Otherwise, nobody would ever loan anyone any money. So when you invest, you're essentially taking on that risk. Creditors take on slightly less risk because they get the first claim on the assets. For instance, if a company fails, there's a bankruptcy, that sort of thing. In the accounting process, there are various inputs, receipts. You buy something and you receive a receipt for it. You may issue a purchase order, saying that you will pay for a certain thing that when you receive it. Things like payroll records, bank records. These all are inputs into the system, providing us with information to be processed. And then, of course, there's the actual processing. A journal entry where we make an entry, record a transaction. And those entries are then posted to accounts. Then those accounts are summarized. And then after that, they generate the outputs. And those are essentially the financial statements, such as the balance sheet, the income statement, the cash flow statement, and the statement of retained earnings, or retained earnings statement. Can be said either way. And we'll get into all of those going forward. Of course, all of these can be summarized in annual or quarterly reports. Accounting follows certain rules that are referred to as the generally accepted accounting principles, or GAAP. And the GAAP rules are created by at least in the United States, by the Financial Accounting Standards Board, also known as FASB, which is part of the Securities and Exchange Commission. Essentially, the principle that is followed is called double entry bookkeeping. A transaction, any transaction, there are actually two parts. You go to a store and buy a coat. Well, let's say a company goes, but better yet, a company buys a truck to make deliveries. Okay, that transaction has two parts: the payment for the truck, and then the receiving of the truck. And the truck is an asset which also needs to be recorded. So there, for any transaction, there must be at least two entries. This is what I refer to it as double entry bookkeeping. If there's only one half of that transaction recorded, that throws off the information system, and there's clearly something missing. So every transaction needs to be recorded in at least two places. I referred earlier to certain key financial statements: the balance sheet, the income statement, the cash flow statement, and the statement of owner's equity. These are four very important statements. Even if you're not an accountant, as I am not an accountant, I can read these statements as a manager. I can look at them, and that will tell me certain information. The balance sheet, very important. This is a snapshot of the state of a firm at any given moment. Usually when we look at balance sheets, we look at comparative balance sheets, comparing one moment to another. It is based on this accounting equation: assets equals liabilities plus owner's equity. And you will see, actually, if you look on old balance sheets, you will actually see on one side are the assets, and then the other side are listed the liabilities, and below that, the owner's equity. I actually prefer to think of it in a slightly different way. Assets minus liabilities equals owner's equity. The assets, what you have, minus what you owe, equals owner's equity, what you get to keep. So for me, it's easier to think of it this way. You can think of it either way. Essentially, it's the same relationship. An asset is any economic resource owned and expected to bring benefit to the company. And we'll talk a little bit more about, some examples of assets. Debt, liability is any debt owed to the company. So if you sell something and you sell it on credit, you're owed. I'm sorry, if you buy something on credit and you receive it and you haven't paid for it, that is a liability. That's a debt that you owe. And owner's equity is the amount the owners would receive if all assets were sold and all liabilities are paid. So it gives you a sense of the overall health of the company if you have a strong owner's equity. Assets, as I said, are any economic thing you own that can bring benefit to the company. Probably the most important one is cash and certainly securities, because these can be converted into other assets. Any inventory you have, merchandise, if you have a store and you've purchased merchandise to sell, you can sell it and make money. So that is considered an asset as well. That includes raw materials that are not ready to sell but can be turned into a product. For instance, if I make wooden tables and chairs, I might have a stock of wood, in my factory that is yet to be turned into anything. So that would be considered raw material. That is certainly an asset. Work in progress. Let's say I've assembled or I've cut the pieces for the table and chair. Maybe I've assembled them, but I haven't finished them. I haven't put the polyurethane or shellac or paint or whatever I'm going to put on them. It's not ready to be sold, but it's not raw materials. It's the in-between state. So we call this work in progress inventory. And then, of course, finished goods, goods that are ready to be sold. We also have accounts receivable. That is an asset. That is money that is owed to you. You don't have it yet, but you will. And in our balance sheet, that is considered an asset. So let's say you've sold something on credit, and you haven't been paid yet, but you will be paid. It is expected to benefit the company. Eventually, that money will come in. Any prepaid expenses. So let's say you prepay your rent or insurance, that is considered an asset that can help the company. Any fixed assets. So you have land or your factory, your plant, any equipment that is used to create a product. So let's say the machinery used to cut the wood and shape it and sand it down. This would be considered fixed assets. Any intellectual property. These are somewhat intangible. Patents, copyrights, trademarks. Certainly, if you have a copyright or a patent to an invention, that is an asset that can bring you benefit, that can bring the company benefit. Sometimes, and there are disagreements on how to value this intellectual property, but that's sort of another issue. But certainly, if you own the copyright to, let's say, a certain songs or books or something like that, or a patent to an invention, that means only you can manufacture it, or you can license it out. You can actually benefit in a number of different ways, and that of course is a management decision, guided by accounting, of course. Liabilities. There are two types. There are current liabilities. These current liabilities are anything that needs to be paid within the next year or less. It might have to be paid within 30 days. These are all considered current liabilities. Then, of course, we have long-term liabilities. These are usually long-term loans. Think of it like a mortgage would be a long-term liability. Of course, long-term liabilities turn into current liabilities as the due date gets closer. But it's basically not due for a year or more. Sometimes there is a little bit of confusion about the difference between an asset and an expense. If I go and buy something, is it considered an asset or an expense? And the difference is that assets are unexpired costs. So if I buy, again, a truck to do deliveries, that's an asset. It can help me, and I can keep using it for a long period of time. Expenses are expired costs. So let's say I buy some things and use them up. Let's say I buy some merchandise and I sell it, then it moves to an expense. If I use something up, in fact, things that are of low value, like pencil and paper, those are considered expenses, because unless you are in the business of selling pencil and paper and you have inventory of that. But if I'm just using them, things to be consumed by the company are generally considered expenses. And there are some FASB guidance on that, on what is when it should be considered an asset and when it should be considered an expense. And there are, of course, arguments and disagreements, and it becomes a gray area. But essentially, an asset is something that will continue to bring benefit to the company. An expense is something that brings no benefit or very little benefit within itself. Now, sometimes you talk about expired assets. Do sometimes expire. They become of little value to a company. Let's say you've had a truck for 20 years. There's probably not a lot of value to that truck. It's probably going to die soon. So we have a process of converting assets to expenses, and we call this depreciation. We usually do it every year. We depreciate our assets a little bit. So and anyone who's ever, for instance, bought an automobile knows that once you drive it off the lot, you've purchased it and you've driven off the lot, the value goes down because now it is used. And so you probably can't turn around and sell it for the same amount of money. So its value has gone down. Certainly after a year, 2 years, 3 years, it's gone down. For instance, if you have a car for a year or two, you can sell it for several, probably for a few $1,000s. If you've had it for 10 years, you might only be able to sell it for a few hundred. So accounting provides for a method for periodically reducing the value of our assets. And this is important. When for a client, I once went to a bank to try to secure a loan, and we talked about assets, and they said, and one of the problems was they looked at the assets, and a lot of it was office equipment, and they said, this is, they're thinking in terms of collateral. Said these assets aren't worth very much. These computers are, several years old. They work, that's fine, but we couldn't, if we had to place a lien on them and then seize them, because you didn't pay or your client didn't pay, we wouldn't get very much for them. So they're, those assets have been depreciated. Now, you may depreciate an asset and eventually may go down to zero. Does that mean you have to get rid of it? No, you can continue to use it, but from an accounting perspective, it is considered to have no value. And of course, there are certain assets that are difficult to depreciate, because you don't know how long you're going to have it. For instance, airplanes. For instance, you take a 747. These were airplanes that were built probably before most of you were born, but they still fly. They're very durable assets, and they could be valued at zero, or they could still have some value. You can still sell them. So there is a certain amount of flexibility in the depreciation process. This is one area, however, where things differ when you get into tax accounting. The government has specific depreciation schedules that they impose. So you have to depreciate certain assets by a certain amount by a certain time. So the next statement is the income statement. This, I think, most of you will understand much more intuitively. Essentially, we're dealing with revenues, the money we take in from sales. We subtract the expenses, and from there we can calculate our profits. Revenue is the money received as a result of the sale of the product or service that the company offers. So let's say that we're in the shoe business. We're a shoe manufacturer, and so we manufacture shoes. We sell them, and we have a truck that we use to deliver those shoes to somebody. Okay, so we sell our shoes. That is considered revenue. But remember, we had that truck. It's the old truck. We've decided to sell that truck, and let's say we get $1,000 for the truck. That is not considered revenue, because that's not the business we're in. We're not in, unless we're in the truck business. That doesn't count as revenue when you sell off assets, because that kind of might skew the financial statements and be somewhat deceptive. So revenues are strictly what we normally buy and what we normally sell. Expenses are the cost of creating that product or services for sale. And there are different types of expenses, and we'll talk about that in a moment. And of course, income or profit is the money that remains of those revenues after the expenses are deducted. This is, I think, fairly intuitive for most of you. But of course, in accounting, things are a little bit more complicated. So let's take a look at a theoretical income statement. So let's say for our firm, for whatever period that this income statement covers, and this is one difference between an income statement and a balance sheet. A balance sheet, again, as I said, is a snapshot in a specific moment in time, whereas an income statement covers a particular time period, a month, a quarter, a year, whatever it is, where a balance sheet is for a specific moment in time. Okay, so we've made sales of $500,000. That's great. Then we have the cost of goods sold, or COGS. These are the expenses that are specifically tied to the production of that product. And you might have different income statements for different parts of a company, different divisions, but then of course there'll be an overall income statement. So let's say, again, we're in the shoe business. It is the cost of the leather, the soles, the laces, the labor to create that. Maybe some of the utilities, you know, electricity and other utilities used to create the product. Some companies will include maybe the marketing costs in there. And again, we have to look at the individual rules. And different companies do it a little bit differently. And they're usually on the financial statements, little notes to have, you know, explaining how certain things were calculated. So we do a simple subtraction problem. 500,000 minus 170,000 leaves us with a gross income of 330,000. Basic subtraction. You'll find actually in accounting, a lot of the math is fairly simple. It's just making sure you apply the appropriate operation to the appropriate numbers. Okay, so we have $330,000 of gross income, but there are other expenses that we need to take out. Think about, we call these operating expenses. These would be maybe the salary of certain executives, or a security guard, or a receptionist, maybe the salaries of people in human resources or other staff areas, as opposed to line areas. Line areas are directly responsible for revenue and production and so forth. So other staff areas. Maybe it's the cost of maintaining the landscaping around your building. You know, all things that have no direct bearing on the production of the product or the selling of the product, but the support areas. So then we do another subtraction, and this is now we get into some interesting terms. Next, what we've calculated by subtracting our operating expenses from our gross income is we get earnings before interest, taxes, and amortization, also referred to as EBITDA. Because there are other expenses that we're going to take out. So we're not including the interest, taxes, and amortization as an expense yet. We will do that in the next few lines. So then we also have to subtract, if you remember, our depreciation. Remember, we're turning those assets, expiring them into expenses, and that happens periodically. And so we're going to now subtract the depreciation. Depreciation is a purely internal transaction. It is, you know, it's not something that has anything to do with any outside party. So we'll do another subtraction, subtract 30,000 from the 210,000, and that leaves us with 180,000. And this is referred to as EBIT, or earnings before interest and taxes. Now we also have to subtract the interest rates. Now, interest, if we've borrowed money to maintain the operations of the company, or for whatever reason whatsoever, we have to pay interest on that money. And so we subtract that here. And this leaves us with EBT, earnings before taxes. We leave taxes for last because we want to be taxed on the lowest amount. And also this follows the the GAAP rules, generally accepted accounting principles. So then we have to calculate the tax. Now, it will depend upon where you are, what the tax rate is. In the United States, the federal tax rate is 25%. So 175,000 times 25% equals 43,750. You can check my math, that's okay. And so we subtract that amount, and that leaves us with net income of $131,250. That's our final profit. So it's just a series of subtractions with, I guess, one little multiplication thing in there. Again, with the taxes, you know, there's also state taxes, and different jurisdictions will have different tax rates, but Okay. Okay. So income statements are very informative. You know, where are the expenses? You look at this, and again, accounting is an information system. You know, maybe our interest, maybe where somebody says we're paying too much for interest. You know, we $5,000, maybe, or maybe not enough. Maybe we need to borrow more money. Or maybe it's an attractive interest rate. So all sorts of decisions that will need to be made based on the income statement. The next statement is the cash flow statement. Again, cash is our most important asset, so we give it a special statement. And the cash flow statement falls into three sections. The first is the cash flow from operations, also known as CFFO. And this one is probably the easiest to deal with. You know, it's what cash did we receive from customers? That's not the same as revenue, because remember, our revenue, we might account for, let's say, people who use credit cards, but we haven't received the money yet. So it has to be only if we've actually received the cash. Credit cards and checks don't count, at least until they clear. Any money we pay out to suppliers, again, not on credit. This is what we actually pay out. Any interest and taxes paid. Okay, we're tracking cash, not liabilities here. Any interest and dividends received. Then we have the cash flow from investment. This is when we're investing in our company. Let's say, you know, things like covering the purchase of you know, equipment for production purposes. And so these are we include capital expenditures here. Any proceeds from the sales of fixed assets. So if you remember, we talked about that truck, that if we sell it, we can't count that as revenue. This is where we record it. So, and then cash flow from finance. And sometimes I understand it's easy to mix up cash flow from investment with cash flow from finance, but this has to do with, you know, where do we get the money to finance? We might issue short-term debt. We might, you know, sometimes refer to as commercial paper. Basically, we take loans, and any proceeds when we get, the reason we take a loan is to get money. Well, this is where we record that loan that we're receiving, and then we have to pay if we pay off any debts that we owe. So, and you know, when you take your accounting class, you'll probably go into the cash flow statement in much more depth. This is always the one I meant when I was studying accounting. This was the area that gave me the greatest trouble. But you know, particularly with CFFI and CFFF, investment and finance, that's where things get a little confused. So you have to be a little careful there. Okay, and now also any payment of dividends. Then we move on to the final statement, the statement of owner's equity. This was a relatively simple statement in comparison to some of the others. Here we're measuring, you know, what's left over and how we're dealing with it. And this is sometimes called the statement of retained earnings. Again, people say it a little bit differently. It doesn't matter. So we start with the retained earnings from the previous year. This is what's left over, what was kept inside the company, because sometimes from the retained earnings, some of it you will pay out in dividends. So this is what we retained from last year. Then we add to that the income from the current year. So, you know, the net income. And then we pay out dividends to shareholders because they're the owners and they should get something out of it, usually. And then that calculates the retained earnings for the current year. So let's say our retained earnings from last year were $125,000. This year we've added $75,000 from our operations, and then we're going to pay out $60,000 to our shareholders, and this leaves us $138,000 that we keep inside the company. Uh, you don't generally you don't want to pay out all of your earnings because you usually need some working capital. You need to stay a little bit liquid, and there may be more opportunities to invest or to do opportunities in general that the company wants to take advantage of and needs cash to do so. So this is a very simple calculation. We also do a few other extra calculations. Earnings per share. So let's assume there are 100,000 shares are outstanding. So and that means shares not held within the company, but actually held by owners. So you buy shares of stock on the stock market. You will have, you'll be part of those outstanding shares. So we simply do a division problem here. We take the earnings and we divide it by the 100,000 shares. The $138,000. You can see the retained earnings from the current year, and if we divide that by the 100,000 shares, that means each share earned $1.38. So earnings per share, and this allows you to maybe compare to other at other times. Not necessarily good to compare to other companies because other companies will have different amounts of outstanding shares. So for instance, let's say there was, the company did a stock split, and that is that they gave every shareholder an additional share for everyone they have holding, and this happens currently every so often. That would mean that the earnings per share would be half. So it's a function of how many shares are outstanding, but you can compare from year to year. And also you want to take a look at the number of outstanding shares to make sure there hasn't been a shift. And we calculate dividends per share in a similar way. We're going to pay, if you see, we're going to pay $60,000 out to shareholders. So the $60,000 divided by 100,000 shares means essentially the dividends per share is going to be 60 cents. 60 cents for every share you own, you're going to get 60 cents, or the owner's going to have. So for instance, if you own 100 shares, you're going to receive a payment for $60. So and many most companies will pay dividends. Some companies try to keep it all in retained earnings because they think that there are some growth opportunities. A lot of young, growing companies do this. Apple for many years did not give dividends. Microsoft for years did not give out dividends. But then once they start growing and really growing, and you can't keep that growth rate up, they decided, well, we can't really make the best use of the cash, so we'll pay it out to our owners, through dividends. Okay. Well, I just talked briefly about the Sarbanes-Oxley Act. The Sarbanes-Oxley Act is a law passed federally, I think back in 2002. 2002 was a particularly bad year for business scandals, accounting scandals, particularly at one company called Enron, which was an energy company. And they did a lot of misrepresentation on their balance sheets and in other, particularly on the balance sheet. I actually personally knew the culprit behind the Enron scandal, a gentleman named Andy Fastow. I didn't know him well. We went to high school together, but I don't say that with any pride. He really deceived the shareholders and the employees about the balance sheet and the financial statements in general. He did some things that were really very deceptive. So the Sarbanes-Oxley Act, in reaction to that, and there were a number of problems. One problem was with the auditors, a firm called Arthur Andersen. Arthur Andersen, as we said, companies, accountants, and the accounting system allows for a lot understanding what's going on inside a company. And often because of that, accountants are often often give advice. And in fact, many accounting firms became consultants. And this is sort of a separate payment to them. Accounting firms, auditing accounting firms are basically brought in, and they're paid by the company, but they're paid to certify that their books are correct. And they have to certify, and this is a matter of the accounting firm's reputation. Enron, for instance, still exists. They changed their name, but that company is still out there. It was diminished by the scandal, but it still operates. Arthur Andersen doesn't exist because their reputation was completely destroyed. I was actually at a stockholder meeting at another company, and they announced that they were no longer using Arthur Andersen as their accountants. Not that, and the reason is, and this is, the company was Merck, the pharmaceutical company. They fired them because Arthur Andersen now could no longer be trusted. And if any company used Arthur Andersen, their books, their accounts would be suspect. So one of the things Sarbanes-Oxley did, and one of the reasons Arthur Andersen did what they did for Enron is because they were getting all these side consultancy payments. And so that was a conflict of interest. To pay them for the auditing was one thing. To pay them extra money for consulting was too much of a moral hazard, too much of a conflict of interest. So Sarbanes-Oxley also strengthens protection for whistleblowers, people who say something is amiss and alerts the authorities or alerts senior management. Also, and this is very important, requires the CEO and the CFO, the chief executive officer and the chief financial officer, to certify the accuracy of financial statements. They're taking personal responsibility for the accuracy. So the idea is they should not be able to say, well, I didn't know anything about it. The law requires that they do know about it and that they question and challenge this. In the case of Enron and some other companies, it was clear that the CEOs and the CFOs knew exactly what was going on. In the case of Enron with Andy Fastow, who was the CFO, the chief financial officer, he directed it. He said, I want you to take all this debt and put it into our subsidiary, which makes our retained earnings and our owner's equity look our owner's equity look much a bit larger than it actually should be. So got to be careful about that. Also, it prohibits loans to directors and executives. Often companies would loan money to directors and executives with no particular plan for paying it back. It was called a loan. They weren't taxed on, since it was a loan, they weren't being taxed on the compensation. And so that was something else that was going on. Also, it threatens penalties and felony charges to those who alter key financial audit documents. So this is essentially to fortify our accounting system in this country. So, if you want to invest in a stock and you want to look at the financial statements, you should feel confident in that they are truly representative of that. Okay, moving on. There are, of course, several accounting problems that can come up. Well, I'm sorry, problems I'm going to give you here. So here we have revenues $125,000. The cost of goods sold is $35,000. What is the gross income? So you might want to stop the recording and do the calculation, and then I'll reveal what the answer is. Okay, so the way we would calculate gross income, again, if you remember from our income statement discussion, revenues, COGS are subtracted from our revenues. So 125,000 minus 35,000 would leave us with a gross income of 90,000. Very simple. Admittedly, I use very round numbers, but very simple calculations here. Let's say our assets are 5.5 million or 5,500,000. The firm owes the bank 400,000. And the firm has $2 million in other accounts payable. That means that they owe money. Based on this information, what would the owner's equity be? Now, this would be a calculation for the balance sheet. Remember, assets on one side, liabilities, and owner's equity on the other. So you might want to stop the recording and see if you can do the calculation. Okay. Assets of 500,000. I'm sorry. 5,500,000. The bank owes. The firm owes the bank $400,000. That is a liability. The firm has other accounts payable. That is money they have to pay out. That's another liability. So you could just add the liabilities together, which would be $2,400,000, and then subtract that from the assets, or you could subtract each of these liabilities from the assets individually. Do that. So basically, the 5,500,000 minus the 2,400,000 would equal $3,100,000. So hopefully you've calculated that correctly. Another one, of the earnings, company firm will pay out $4 million in dividends to stockholders, and the firm has 8 million shares outstanding. So what is the dividend per share? And this calculation would be from the statement of owner's equity. So this is, well, I'll give you a moment to maybe stop the recording and try to calculate it. Okay, so we're paying out $4 million, and we have to essentially divide that among the 8 million shares. So it's a simple division problem, which essentially the 4 million divided by 8 million leaves us with 50 cents or half a dollar per share dividend. The firm has $40 million in retained earnings. What is the earnings per share? Again, we're still talking about 8 million shares outstanding. So I'll give you a moment to figure that out. Okay, that calculation is also a division problem. It would be the 40 million divided by the 8 million, which would give us $5 per share, earnings per share. So, okay, most accounting problems are simple, basic operations. Addition, subtraction, multiplication, division. Occasionally a percentage calculation. What is daunting about accounting for many people is actually the number of calculations you have to make and just determining which equation or which calculation has to be made. The actual doing of the calculation is usually fairly simple. Most of us will use a calculator or maybe even a spreadsheet to do it, or accounting software. Okay, I know that you can't ask me any questions during this video, but I would encourage you, when we meet in class, figure out what questions you might have, and then when we meet in class, you can ask me the questions then. All right, take care.